Have you ever hesitated to invest because you thought you didn't have enough money? Maybe $100 feels trivial when talking about building wealth, but here's the truth. Every great investment journey starts small. You don't need thousands to begin, just a decision to start. With $100, smart choices, and time, you can build momentum that surprises even you. The real secret isn't the amount you're starting with, it's getting started. We live in a world where information moves fast, but true wealth grows slowly. Compound interest is often called the most powerful force in finance. When your returns earn their own returns. That steady snowball effect can turn even small balances into meaningful sums over time. Suppose you invest $100 today and earn an average of 8% per year echoing historical market returns. Without adding a cent more, in about 30 years, that money nearly multiplies tenfold. But wait, if you add just $20 or $50 each month, you are not just growing your original $100. You build a routine that moves your whole financial trajectory forward. You'll hear a lot about needing deep pockets to invest. But thanks to modern tools, you can open an investment account with no minimum deposit. Grab a fractional share, the ability to buy a slice of a stock or fund, and start with exactly what you have on hand. Apps and platforms like Fidelity, Schwab, Robinhood, Sophie, Public, Betterment, Wealthfront, Acorns, and Stash empower you to invest even with amounts that used to be dismissed as too small. The most beginner-friendly way to begin is with index funds or ETFs that track a broad market benchmark, like the S&P 500. Instead of picking individual companies, you buy a slice of hundreds of them. This gives you automatic diversification. Your little investment is spread across big names like Apple, Microsoft, Johnson & Johnson, Amazon, and countless others. You're betting on the market as a whole, not trying to guess the next hot stock. Over decades, markets trend upward, even if they wobble in the short term. If you'd like a hands-off approach, Robo-Advisor's automated digital platforms can handle the rest. You answer simple questions around your goals and tolerance for risk. Deposit into your account, and they build and rebalance a portfolio for you in the background. This setup removes emotion from the equation and helps people invest consistently without worrying about timing or stock picking. Micro-investing apps add another layer of ease. For instance, Acorns rounds up each purchase. If you buy coffee for $3.70, it invests the extra 30 cents. Those small amounts pile up automatically, almost invisibly. Stash lets you invest fractional amounts of popular companies or funds. Beginnings like these help build the habit before you need to think about it. Even your first $100 can be invested in dividend-paying. These funds distribute a small portion of their earnings periodically, which you can reinvest in more shares, growing your portfolio without extra deposits. Many platforms let you automatically reinvest dividends at no cost, amplifying the compounding effect. To be effective, every investor should plan to invest consistently. It's the single most important habit. Scheduling regular deposits weekly, bi-weekly, or monthly reduces the temptation to time the market and builds discipline. This practice, called dollar cost averaging, helps smooth out your purchase price over time and increases your buffer against market swings. Over time, even small automated contributions add up. Let's say you deposit $50 a month into a diversified index fund, earning 8% annually. After a decade, you'll likely have around $10,000, an amount you regret not investing earlier, but also proof that the habit works. Stretch that out 20 years, and you'll be looking at $40,000 plus with continued consistency. The exact numbers may vary, but the message is clear. Time and persistence are your biggest allies. You might wonder if you'll lose money. Yes, markets go through ups and downs, even sharp crashes, but historically, they recover and continue climbing. If you panic during dips and sell, you lock in losses. The better approach is to stay invested, trusting the long-term trend while your money works for you. Another advantage of starting small is psychological. A $100 beginning doesn't feel risky. It's easy to sleep at night when you remember you're in it for decades, not days. As your balance grows, you can learn, explore different funds or account types, and implement stronger tax strategies without jeopardizing everything early on. Alongside investing, you should still keep foundational habits like maintaining an emergency fund, reducing high-interest debt, and tracking your budget. If you have a credit card bill or a similar debt offering 18% interest, paying it off first can deliver more guaranteed return than your investments may earn. Once debts are managed, your focus can shift more boldly to market opportunities. Taxes will matter as your account grows. Investing within tax-advantaged accounts like Roth IRAs or traditional IRAs can significantly boost your long-term gains. A Roth IRA, for example, shelters your earnings from future taxes so that withdrawals during retirement are tax-free, provided rules are met. Many brokerages allow you to open these accounts with no minimum, and gradually you can fund them with your initial $100 to start the cycle earlier. Understanding the difference between short-term and long-term investment returns is crucial. Long-term returns are taxed favorably, while short-term gains are taxed at higher ordinary income rates. This further underscores the case for holding, not trading, especially as a beginner. As your portfolio matures, you may explore other strategies. Increasing international exposure, adding bond funds to reduce volatility, or dabbling in REITs. But you needn't worry about that now. When starting with $100, your best bet is simplicity and automation. Complexity is for later chapters of your journey. You'll also face choices like setting up automatic transfers, reinvesting dividends, and tracking your progress. A set-it-on-forget-it system works wonders. Over time, you'll look back and be amazed that such a simple plan moved your financial trajectory. It might start slow, just a few dollars here and there, but the mathematical power of compounding keeps adding up behind the scenes. There may also be emotional challenge, the temptation to chase hot investments, panic selling during market drops, or switching strategies. But if you stay true to the plan, focus on your long-term goal, and avoid speculation, you'll avoid most beginner pitfalls. Use reputable sources to keep learning. Books like The Simple Path to Wealth and Common Sense Investing, websites like Investopedia and Bogleheads, and podcasts dedicated to personal finance offer reliable guidance. They remind you that slow, steady, and low-cost investing works better than chasing short-term excitement. And as you deepen your understanding, you can gradually increase your contributions. $100 becomes $500, becomes $1,000 a month, or take advantage of tax-advantaged accounts and plans like 401s. But the core principle remains. Every great journey starts with a single step. In this case, that step is your first $100. You don't need to be perfect, you just need to begin. When you make that initial deposit, you're aligning your present self with your future self. Person you'll thank for giving your money the chance to grow. You're saying, I'm choosing to build something. You're opting into the system that rewards patience, discipline, and time. So, here's your challenge. Take your $100. Choose a friendly app or brokerage. Enter the ticker for a broad index fund or ETF and click buy. Then set up an automatic deposit, say $10 or $25 a week or month, and don't touch it. Let it run. Let time do its thing. Thank you for watching. And remember, investing isn't about magic or insider secrets. It's about tiny actions, repeated consistently. That's how wealth is built, not all at once, but one small decision at a time. Happy investing.